So I'm real happy today to be able to introduce Scott Jewett from MarsJewett Financial. You probably have read some of my articles. I'm the Stewardship chair. Don't ask me why I did that, but I did. And I'm happy I have. It's been very enlightening. But one thing I mentioned in the last letter was financial giving. You know, that we always kind of go, oh, here comes to talk about money again. But you know, financial giving is what turns the lights on. Financial giving is what pays our staff, and financial giving does a lot of things as far as giving money for outreach and so forth. And I thought, let's talk about financial giving in a positive way, in a graceful way. And Scott, as he's my financial advisor, and a few others in my church. And we've always, for the last 10 years, I've had a chance to know him as far as his passion and compassion when it comes to giving, you know, to the things that we think is important to us. And so I thought today we'd like to have him here and talk about graceful giving. Scott, do it.
Good morning. Thanks. Honored to be here. And just talking about charitable giving strategies is really, giving's not complicated. You can write a check to do it. But the strategies around it, are there tax smarter ways you can do it than just writing a check? Really, the federal income tax started in 1913. An amendment to the Constitution was passed, and the first tax returns were filed in March 1914. But as they were doing that, one of the things they wanted to do is they used the tax code to incentivize certain things. And you know, we can think of what those things are. They're mortgage interest and charitable giving, medical expenses, and you know, state and local taxes are things that you can itemize. And so the government said, hey, if you do these things, we will give you a break on your taxes. And so today I'm just going to talk about some of the different strategies of ways we can help the government partner with us in our giving. And just for starters, this chart here shows the giving, you know, how much giving was each year. And notice in 2022, it was $500 billion. And of that, 64% was individuals in their giving. I think a lot of us think that, oh, the giving, that's corporations and other things, but most of the giving is actually individuals that are doing the giving. And so really, kind of the focus is going to be what are the tax strategies around giving. And so I'm going to talk about 6 of them, and then just a couple of charitable vehicles that people use to implement these strategies. So the first one is called bunching deductions, offsetting high income years, your Roth. Some people do Roth conversions and giving with that, donating highly appreciated securities, harvesting concentrated low basis stock. I promise I won't go into painful detail on all of this. I'll keep it at a high level. And then qualified charitable distributions. So the first one is bunching. And so one of the things that has happened as of the 2017 change in the tax law, really the design was, hey, let's make it more equal as far as itemized deductions. Some people have mortgages, other people don't. And so some people would benefit more from being able to itemize deductions. And so one of the things that tax law did is it doubled the amount of what they call the standard deduction before you're able to benefit from itemizing. And so today, until you have $27,700 of itemized deductions, you don't benefit from charitable giving in being able to itemize. And so the vast majority of people aren't able to itemize their charitable deductions. So bunching is a strategy that helps with that. And so what this is here, so here's somebody in year one, let's say in this example, they're giving $12,000 a year. And so in year one, they give $12,000. They've got $6,000 of mortgage interest, $10,000 of state and local taxes, And so in this case, they have $28,000 of itemized deductions. So their benefit is they're $300 over. They're able to itemize, but it only benefits them by $300. So year 2 and year 3 are exactly the same. So here's how bunching works. So in this example, make sure we got it here. There we go. So in this example, in year 1 instead, this person or this couple, they give $36,000. They give 3 years worth of giving in 1 year, and so that takes them $24,300 above that standard deduction. And so in that year, they save their tax bill is $8,505 less. When we get to vehicles, we'll talk about a vehicle that you can use to do something like this. So what you do is in year 1 you do the gift, in year 2 and year 3, you're using that money, it's your charitable giving, and you're taking advantage of the standard deduction. And that creates in a tax savings of about $8,200 more using the top marginal tax bracket. So if you're in the 22% or 24% bracket, it'd be a little less than that, but significant tax savings for that strategy. And in this one, sometimes people have an abnormally high income year. Could be because of a taxable inheritance. Sometimes people have inheritances that are taxable. Could be something at work, or I've seen it where people have owned a stock for a long time that they were going to owe a lot of taxes on, and a merger forced the sale. There's a lot of different reasons why you might have a high income year, and so it's kind of a bunching strategy. But if you have a high income year, giving a proportionate amount or a higher amount in that 1 year will allow tax saving, additional tax savings there. And in this example, giving its tax savings of $11,700. And feel free, along the way, if you have questions, you can ask. I'll also take questions. I'll also take questions at the end. So this next one, there's a financial planning strategy that often gets used called a Roth conversion. Anybody heard of a Roth conversion? Yep. So Roth conversion is moving money from an IRA, which is taxable, over to a Roth IRA, which gets taxed one time, then all the income from it going forward is tax-free. And so sometimes if you've got money to pay the tax outside, or money to pay the tax or to give, you can do that Roth conversion, and you can lower your taxes by doing a big charitable gift in that 1 year, which helps offset the income from that Roth conversion. The strategy works best if people do Roth conversions if they expect, hey, going forward, I'm going to have higher taxes in the future. And why might that be? Typically, if you're near retirement age, if you're expecting higher income in retirement, it's because you have a lot of money in what are referred to as qualified savings plans. So IRAs, 401ks, that sort of thing. When you get to now it's age 73, you have a required minimum distribution, and that will start throwing off high amounts of income. So oftentimes people that are in that window before that age will do Roth conversions to lower their tax bill out into future years. This next strategy is often have, especially around here, we have people that have invested in companies like Microsoft all the time. I see people that, hey, they bought into this little company called Microsoft back in the late 80s or the early 1990s, and they're sitting on top of massive capital gains. Maybe they want to sell it. Maybe they don't want to sell it for now. But if they were to sell it, it would trigger a big tax event. And in this example, the stock is the stock is Twitter. But let's say, for instance, you're trying to decide, hey, I've got stock, and if I sell it, I'm gonna have a big capital gain. Or, I can use my cash. In this case, it's a great idea to donate the stock to the charity. Whether most charities, churches have accounts set up to do this because it benefits them. So when that gift is made, you get the deduction for the full amount of the gift. The charity that receives the stock can sell it, and they don't pay taxes because charitable organizations don't pay income taxes. So the only one that loses in the transaction is the government, but that's by design. They want to encourage charitable giving. So in this example, it's a comparison between donating cash and donating stock. So in this case, the stock has a value of $50,000. If you were to write a check for $50,000, sell the stock, you'd pay a capital gain. In this instance, it's a gain of 23.8%, so the tax would be $7,140. So in this instance, if you gave the stock instead, you wouldn't have that capital gain. And then you get the tax benefit. There's a difference of about $3,000. So it's a strategy that gets used frequently. It's a really effective strategy for minimizing taxes. So what this chart is showing is is just the difference between it. So that first chart is if you gave cash, you benefit from giving cash as long as you can itemize it. So if somebody gave $10,000 and they're in the 37% tax bracket, the tax savings, you would get a itemized deduction of $3,700 for that gift. But if you had stock that was 50% basis, that means half of it's gain and half of it is what you invested in it, you'd still get the $3,700 charitable deduction, but then you would avoid the capital gains tax of $1,200. So your cost would be $5,100. And I think one of the things, it's a good time to clarify that. There's some people have a thought process out there that, well, hey, you have to have charitable deductions. There's some people that pitch giving strategies as if it's there's no cost to the donor. Most of us, that's not we're giving because our heart is for that organization. But there are people out there that pitch, you need to do this because it's great. It is good, but there's still costs to it. So it's minimizing the cost of the gift, sharing it with taxes. But and then sometimes we'll run across stocks which have almost zero basis. That Microsoft example that I used long ago, there's some basis in it, but Microsoft has grown so much that effectively there's somebody might have almost all gains in that transaction. And so gifting a stock like that makes a lot of sense. And even sometimes people say, yeah, but I still want to own the stock. Well, give the stock, you get the deduction, you get rid of the capital gains, take the cash that you were going to use to give instead and rebuy the stock. And what you've done is you've increased your cost basis so that the capital gains in the future are smaller. So it's a good strategy. It's not hard to do. If you had stock that you wanted to donate, you touch base with with the church or with whatever organization it is and ask, hey, how do I do that? And it's just a process of them telling you, here's how you make that transfer. Okay, this last strategy here is probably one of the most common strategies, and it didn't used to be until that standard deduction, that doubling of the standard deduction in 2017. So the way qualified charitable distribution works, you have to be 70.5 in order to do it. And if you are, you can make your gifts to your church or charities directly from your IRA. And what are the benefits of that? Well, as I said, most people aren't able to itemize. So doing the gifting from your IRA, when you do that, you don't have to pay taxes on your distribution. It goes to the charity; they don't pay taxes on it. So you're making a tax-free use of your IRA. And if you're not able to itemize, then that's a win for you. So it's one of the things where we rarely used it when the standard deduction was half of what it is. Now we use it a lot with clients because they're wanting to give, but giving tax-free is a much better way to do it. And so we use it when donors aren't able to itemize. We use it when the majority of their assets are held in an IRA. Lots of retirees, they've got some money in the bank and maybe a little money in other places and lots of money in their 401ks and their IRAs. And all of that money as it comes out is taxable. So if you can do your giving tax-free from that, it's a smart strategy. And then also we'll use it when the required minimum distribution, again at age 73 you have to take money from your IRA. And sometimes that money that you have to take out is pushing you up into the next tax bracket. So again, giving from your IRA helps keep that, can help keep you under that. And then a lot of times it's, let's say somebody owns appreciated stocks or homes or whatever it is, and it's like, which of these strategies do we do? Well, if you're able to itemize, it might benefit you to give the appreciated stock versus a qualified charitable distribution. And then, if you're in a lower tax bracket, maybe the qualified, or maybe the giving appreciated securities makes more sense. But they're both really good strategies. Mark.
Yeah, Scott, this one you mentioned the DAFs, the donor advisory funds, and we have one of those. It's very useful in the bidding strategy. So could you cover that a little bit?
Yeah, it's coming up.
Oh, it's coming up.
Yep.
Okay.
So that's so any questions on the strategies, and then I'm going to get into some of the vehicles that you can use to implement these. Yes?
Actually not wrapping.
Bunching?
Not bunching. The low basis.
Yeah.
Creating that out of a company. How does that work into these strategies?
Okay, so let's say you want to make let's pick a number. Let's say I want to give $10,000 to St. Andrews. In that instance, let's say you own Microsoft stock, and of that $10,000, $2,500 was your initial investment. And so if you were to sell it, you would, on your tax return, declare a capital gain of $7,500. You'd pay your tax on that, somewhere between 15 and 23.8%, depending on your tax bracket. And then you would give it. So instead, you would gift the $10,000 worth of stock to St. Andrews. I'm sure they have an investment account set up to receive that stock. They would sell the stock. You get a donor giving, your gift letter from St. Andrews saying, hey, you gave $10,000. You still get to use that whole deduction.
Hold on a second. If you own the company and you're liquidating it and you sell the stock, is that still legal?
You would definitely talk to an attorney. It's in the structure, so yes, there might be some things. There's some nuances in the tax law related to, closely held companies. But you still can. And if you're thinking of, hey, I have this business and I'm going to sell it, then definitely work with a tax attorney and CPA to make sure the design is set up. But there are strategies, and it's not the scope of this conversation, but there are definitely strategies that you can do that. Any other questions on that? All right, well, let's go. Let's talk about the giving vehicles that you can use to implement some of these plans. So really there are things you can do. So do your giving while you're living. So knowing where it's going is one of the phrases. But the donor advised funds, I'm not going to talk about private foundations today, but those are vehicles that you can use to give money. And then there's some charitable trusts. I'll just touch on those. Again, not really the scope of the conversation, but just to give you a heads up in case you run into something like that where you're thinking, hey, are there things I can do? So. Okay, so donor advised fund, that was what Mark was talking about. And it's a great strategy. So let's go back to that first example I used of bunching. Let's say, all right, I'm going to do 3 years of giving worth, at once. And if you remember that initial example was somebody that was giving $12,000 a year. And instead, it's like, hey, I want to give $36,000 in 1 year, 0 in year 2, and year 3. But a lot of us don't want to do all of our giving to an organization in year 1. They say, hey, I want to spread that out, whether it's annually or monthly. So there's a vehicle called the donor advised fund that you can use. And what that is that's set up by an organization that counts as a charitable organization. So they're different, Fidelity has one, Fidelity Charitable. They have a donor advised fund. There's lots of them out there. There's one called National Christian Foundation that we use. And so the idea is you haven't decided, let's take that $36,000. You're going to make that gift into this fund. The only decision you've made at that point is it's a charitable contribution. You haven't decided where you're going to give it yet, but by putting it in, it's an irrevocable gift, just like if you wrote a check to a charity. So you can't take it back, but you haven't decided which charities you're giving it to yet. So in that example, hey, put the $36,000 this year, and maybe I give 12 of it this year, 12 the next, and 12 the following year. And then you get to year 4 and say, okay, I'm going to do that again. And so what that does, the advantage of that is that allows you to take a high itemized deduction in year 1, take the standard deduction in year 2 and in year 3, and then you do the process again. Yes?
Is there a minimum of what you can, you have to put this much into one of these accounts? And is there a minimum of what you can give away out of those accounts?
No, there's no minimum to what you can give away, and the minimums are small. I mean, I've set one up with, it's just functional. I set one up with $10,000. It probably doesn't make a lot of sense to do it, a lot smaller than that. It kind of depends on the situation, but many of the accounts, they may have a minimum of like $2,500 or something like that. But that
minimum could be as low as $100.
What's that?
$100.
Yeah.
Yeah, the gifts out of it. Yeah, so you can make small gifts out of it. Yes, exactly. And so like with Fidelities, you can go online and you can handle the giving right from there. You can link up to the organization you want to give to to send it out. So yeah, there's no minimum to the amounts out of your donor advised fund. But yes.
A sort of related question. What is the maximum income before you owe any taxes this year?
This year, it's basically for a single individual, you get the standard deduction, right? So
I'm 78.
You're 78, okay?
So what's the standard deduction this year?
The standard deduction is it's around 15,000. It's high 14.
15,000? Okay.
Yeah. So you don't pay any income until you're above that. And then the other thing is, there's many people that have more income than that don't pay taxes because if your primary income is Social Security,
right,
a lot of your Social Security isn't taxed. So.
Right. So only the pension is taxed. So.
Yeah. So yeah, if you're in a situation where you owe 0 or no tax, then going through all the effort for you're the same boat as if you write checks in that instance. So any questions on the donor advice fund? Go ahead.
Just a comment that when you put your money into a donor advice fund, you could also set up an investment strategy.
Yes, that's a great point. Thanks.
You money while it's
Yep,
there.
thanks for bringing that up. Yeah, that's a great point. So you have money in cash, but if you, hey, this is money that's going to be in there for the next 2 or 3 or 4 or 5 years, there's our investment strategies they can use. So like an example, the Fidelity one, there's a bunch of different portfolios that you can choose. It could grow, could go down. So just depending on when you're giving it, you may take some risk or no risk, or.
It also makes filing your taxes easier because you're basically putting all the money into that and pulling it back out.
Yep.
You go file your taxes, you put in, I made one charitable donation this year to Fidelity, and the
Yep.
rest of it, itemizing all the little stuff.
Yep.
No, it's.
That's
it's
a great
all-
point too, Mark.
It's all, it just shows, yeah.
That's very good. Okay, any other questions on donor advised funds? Like I said, we'll skip the private foundation. So then just some of the other vehicles that might be used, where I've seen it commonly, let's say somebody's had a rental house for years and years. We had a client that this couple, they didn't have any children, they had a rental house that they want to get out of, and really a lot of their estate was going to go to charity in the end. And in this case, what they were able to do is they were able to put the rental house into there's organizations that facilitate that, but retitling it into the name of the charitable organization. And so the way charitable remainder trust works is, in this case, the house went in there, it was sold, so the client avoided the capital gain, and then they were entitled to, they were taking income out of that charity out of that charitable remainder trust for the rest of their lives. And so with that allowed them to, they got a charitable deduction, and it's a calculation. Let's say you're putting in, something, a house that's worth $250,000, not here, right? But but maybe in Wichita, that's put in, some asset that's worth $250,000. And let's say this couple, they're 70. There's a life expectancy calculator. So okay, these two people, IRS expects them to live each of them to live till 85, and they're entitled to take income out of the trust each year for as long as they live. And so that income comes back, they pay taxes on that as income, but there's an expectation that there's going to be a remainder that goes to the charity. It could be a charity that's named, it can be a donor advised fund that could be administered beyond their lives. And it gives them a charitable deduction and income. So it works great, if there's significant charitable intent in your estate. So that's a charitable remainder trust. Charitable lead trust is the opposite. Let's say you have assets that you want to go to your children. Generally, that's where we see it. They want to go to their children, but it's an asset that they don't need in their estate to be okay. And let's take the same example of a rental home. It's donated, and now that income stream goes to the trust for as long as you're living, and then at your death, the value of what's in that trust then goes to your heirs. So it's kind of the opposite of a charitable remainder trust. And then this is just talking about, you have this chart here. So what are the tax deductions you get, and is there growth potential, all those kind of things. I won't go into all the details on that, but it's just there if you come across it as an example. Hey, Scott talked about all these things. Which are the ones that make the most sense for me? Yeah, and then this last one is a charitable gift annuity. Again, it's not as common as a charitable remainder trust or lead trust. At least for me, this is not one that I've helped a client to do. But you give it to the organization, and it's a fixed payment for life. It's not that different from a charitable remainder trust, but the the asset, you give it to the charity, they agree to make a payment to you for the rest of your life. It's giving you retirement income, and then the remainder goes to them at your passing. Yes.
Between those two, is there a particular risk that would make a difference, like the charity going out of business, or?
Yes, that could be a risk. And oftentimes where we've done it, there are organizations that will administer those, and a lot of charities, especially smaller ones, don't want to be involved in the administration. So there's an organization that we've helped clients implement some of these strategies called, it's the acronym is CTAC, Charitable Trust Administration. I can't remember what the C stands for, but they're in Cincinnati, and so they work with a lot of these organizations. National Christian Foundation is another one that does a lot of those. And
so there really isn't that significant of a difference between the two as far as which way you went, whether it was a charitable annuity, a remainder annuity, or a gift annuity.
Yeah, I mean, their nuance is kind of beyond the scope of today, but just knowing that, hey, there's those things out there. I remember that this is something that I heard about, now, talking to, financial advisor, an attorney, an accountant, or people that kind of can get into some of the nuances and strategies. Yes?
You mentioned the National Christian Foundation.
Yep.
A couple times. I had a fund with the National Christian Foundation, and discovered that they would not allow me to make a donation to our Savior's Lutheran Church ever.
Okay, interesting. So that's, yeah.
And the reason was, they wouldn't write out state the reason, but the reason was because they were open to the gay community, as is St. Andrews. If you were to attempt to make an offering, a gift from the National Christian Foundation to St. Andrews, they would probably deny it.
And so when they did that for you, you were able to move your over to a different organization, right?
I moved the whole fund to somebody else.
Okay, that's good to know. So yes, I've heard of that happening with different organizations where they'll have I haven't experienced it personally with Fidelity, but Fidelity, different kind of things like, hey, no, this is, you might run into an organization that does that, but hey, this doesn't agree with our politics or whatever. So if you run into that, you can move your donor advised fund from one place to another. So you're not locked in with that organization that you're working with.
But if you did a gift, you are.
Well, if you wanted to make that gift and you're running into an organization, no, we're not gonna make that gift. You can't make that gift from that donor advised fund, but what you could do then is go open up a donor advised fund someplace that would make that gift and then transfer the whole account over.
No, I understand that.
Yep.
If you made it as a gift annuity, you wouldn't be able to. Is that correct?
Yes, but you would know up front whether that's, say, if the organization wasn't going, because you're setting that up.
That's true today, it's not true 20, 30 years from now.
There you go. Well, I guess that's the one caveat of all of this is tax laws change. And generally when tax laws change, they grandfather, systems that are in place, but that's always a risk. Hey, tax laws can change and change some of the strategies. So one of the things that I find fascinating about what we do is, hey, they change the tax laws. It's like, okay, what changes does that do to financial planning strategies? And so the example I used, the qualified charitable distribution was one we almost never used until the doubling of the standard deduction, because most people that live here in Washington, hey, state and local taxes, maybe that's $10,000, a little bit of medical expenses. If you're doing any kind of giving at all, almost always you're above the standard deduction. So your giving strategies didn't really make sense to go through all the time and effort of doing qualified charitable distributions. But once they made that change, then it became something that made sense for a lot of our clients. And so qualified charitable distributions, very common strategy now. Of all these that I talked about, the two most common ones are the bunching strategy and then using a donor advised fund in conjunction with that, and then the qualified charitable distribution. Those are the two common ones. The other ones may apply in certain situations, so I wanted to highlight those.
I was going to comment that we do this getting to the Fidelity Fund, right? But I still get matching from bowling, even though I'm retired, where they still match retiree gifts to charities. And so occasionally that's gotten to be an issue because the gift will show like it's coming from, the charity was coming from Fidelity, not from me. But most organizations are savvy enough, they will write you a thank you note.
Yeah.
It says, thank you for giving us your money through Fidelity, and that's good enough to satisfy the Boeing to match the gift, right? Because they knew where the money really came from, so.
The other thing to be aware of with a qualified charitable distribution is this: if you do it, when they change the law, there's no mechanism in the tax reporting that comes from the custodian of the IRA, and it has to be an IRA, not a 401k, but from the IRA that shows, hey, I made a qualified charitable distribution. So people get their tax document, they send it off to their accountant if they're doing, having somebody do their taxes. And if you don't tell the accountant, I did this qualified charitable distribution, then that deduction isn't happening because it doesn't show on the 1099-R tax document. And so like if you're doing your own taxes, it's a question that's in the hey, is any of this a qualified charitable distribution? So it's just keeping records, marrying it up with the generally the charity will still acknowledge the gift that you made, but just making sure that whoever's preparing your taxes is aware that you made that gift. So we've been taking some questions along the way. Are there any other questions that anybody has?
Are you a CPA?
I am not a CPA. I'm a certified financial planner. Go ahead, Kim.
So you mentioned annuities. I mean, most people probably know that's an insurance vehicle, so I would guess that basically the risk factor would be a lot safer if a person was worried about risk annuity versus.
Well, in this case, though, it's not a commercial annuity. It's called an annuity because the payment is an annuity payment, but there's an organization that's actually doing that payment out of the money. So, and they're committing to make that payment for the rest of your life. Whatever happens with the value of that money, but it will depend on the health of the organization.
And are those tax-free?
The payments, and we want to be careful here. We're in don't want to give tax advice. So generally, that payment is taxable that you're receiving. You got a deduction for making the gift, and the money coming back is taxable income. Yeah. Any other questions?
Did you talk at all about the feature of using a donor advised fund for putting your contributions for your estate? So that when you die, if you say you're going to give 20 to 25% to charity, you can get that to flow into your donor advised fund and get distributed from that any way you want. And one of the advantages of doing that is every time you decide to make a change in where you're going to donate, you don't have to go to an attorney and get your will.
Yeah, that's a great point. I picked up on that one.
Change your donor advice.
Yeah. So what he's talking about, so let's say in your will, you say, hey, I'm going to leave $25,000, $100,000, doesn't matter what the number is, I'm going to leave it to charity, and in your will, you name St. Andrew's Lutheran Church. But, 20 years down the road, you're not going to St. Andrews, you've moved and you're going somewhere else, you would have to go back to the attorney and say, hey, file a codicil, I'm making that change. And so what you can do is set up a donor advised fund that gets the, gets that portion of the estate. And you're not around to make the distributions, but you can either leave in there, you can just make changes on, hey, upon my death, this is who it goes to. Or like in the one my wife and I have, we named our kids as the successor advisors. So, they can make the decisions, or we can leave instructions to them. This is, generally what we want to have happen. So you're not having to redo your will when you make changes to your charitable intent.
Another feature of doing that is you don't have to distribute it all upon your death.
Yep.
You can leave instructions to, you're going to give to St. Andrews and you're going to give 100,000, you can do it 20,000 over 5 years rather than 10.
That's exactly right. It can be administered on into the future with those successor advisors. And so like with our 3 kids, they could each, make gifts out of there to, depending on, how you leave the instructions. So it can be together or independently. Yes?
Can you think of your Roth IRA as the same as cash, as far as where you donate it to?
So with a Roth IRA, you've already paid taxes on it as long as you're older than 59 and a half and you've owned it for 5 years. The distributions out of there are tax-free. You're not paying tax on that. So yes, the giving amount of, hey, I'm taking $5,000 out of my Roth and then I'm turning around and giving that to charity. That's the, yes, you're not paying tax on that transaction. So if you're going to do that, I mean, if you have a choice between an IRA and a Roth IRA, it's better to give, it from the IRA, at least if you're older than 70 and a half. So.
Well, I think we're out of time. So Scott, thank you very much.